All right, everybody, I think we're going to go ahead and get started. I think most people are in now. Welcome, everyone. In today's presentation, we're going to be covering an introduction to general average. This is one of those topics that always piques people's interest, but it is a little bit more difficult to find concise explanations for. So we're going to try to go in as in-depth as we can today, while keeping things kind of general, since these cases get pretty complicated. All right, my name is Meredith Lambert, and I will be your host and presenter during today's presentation. I am the marketing manager here at Trade Risk Guaranty, which translates to being responsible for researching and creating the educational content for all of you, like today's presentation. This webinar is being presented by Trade Risk Guaranty, or as many of you know us as TRG. We are located in the heart of downtown Bozeman, Montana, and have been providing U.S. customs bonds and cargo insurance solutions directly to importers since 1991. This direct-to-importer business model is unique in the international trade community since it cuts out the need for an additional middleman and allows TRG to become another member of your international trade team. We will be recording this webinar and it will be available on YouTube for future reference. If you want to be notified the moment it releases, I highly recommend you subscribe to our YouTube channel. We also post additional educational videos on YouTube about once a month, so if you are not already, check out the chat box. We're going to try to put the link there for you to subscribe. If not, we will be sending out that link following the webinar. You can also find us by searching Trade Risk Guaranty -TRG in YouTube itself. Now, as a quick reminder, this presentation is for educational purposes only and does not constitute legal advice. Please submit your questions in the question box in the webinar interface throughout the presentation. I will be trying to answer the questions that I can, but for more in-depth questions, we will need to submit those to our cargo insurance experts after the webinar. So if I'm not able to answer any, we will be reaching out after the webinar. I know some people might have some pretty specific questions that will kind of require some further research and maybe some further back and forth. All right, so let's get started. In today's presentation, we will be covering the following topics. What is general average? We're going to walk through a general average example and talk about a couple recent general average cases that have happened in this past year. So let's dive in and get familiar with what general average is. General average is a maritime law that has existed in one form or another since the time of the ancient Greeks. That may sound a little crazy, but there is documentation from that time that addressed jettisoning of cargo and equated the loss of money with the loss of cargo, both of which form the foundation for what general average is today. So the law of general average states, there is a general average act when and only when any extraordinary sacrifice or expenditure is intentionally and reasonably made or incurred for the common safety or the purpose of preserving from peril the property involved in a common maritime adventure. So there's a lot of stuff in there, but what does that really mean? Well, basically, general average is declared by the captain of the ship when cargo, equipment, or funds must be voluntarily sacrificed in order to save the ship from peril in the event of an emergency. Once general average is declared, all parties involved in the venture are required to make a proportional contribution to cover the cost incurred. When it says all parties, that includes cargo owners and the owner of the vessel itself. Since there is no way to determine which piece of cargo will be sacrificed if trouble on the high seas occurs, and there is no way to guess when or where that trouble might arise, the risk must be spread amongst all parties in order to ensure an equitable distribution of that risk. You will notice that the law of general average states preserving from peril the property involved in a common maritime adventure. This means that in order for an event to be considered a general average event, the ship must be preserved from peril. If the ship sinks, this would be considered a total loss and would not be a general average event. However, if the action taken by the ship's crew and master saves the ship, the general average can and most likely will be declared. So you can kind of see if the ship sinks and all the cargo with it, that would be considered kind of, or if you have cargo insurance, that would be filed as a more typical cargo insurance claim for lost cargo. However, if there is a general average event, things work out a little bit differently, which we will be getting into. Now, this is not a complete list by any means, but the following are some situations that could result in the declaration of general average. So some of those examples are fire on board the ship, mechanical engine failure, the ship running aground, piracy or ransom of the ship, or a stop at an unplanned safe harbor. If any of these things result in the crew or the master of the vessel having to take action in order to save the ship, that can result in the declaration of general average. And there are many more examples of this as well. Okay, so now that we understand what general average is and when it is declared, let's look at an example of what happens after it has been declared. Now I'm calling this a general average example because we are going to discuss a hypothetical situation with very simplified numbers. A real general average situation would definitely be much more complicated. So let's say that we have a general average event aboard a voyage that includes 4 different cargo owners and the ship's owner. First, an average adjuster is going to be assigned to the case. Now, an average adjuster is a sworn expert for general average acts, and they deal with the practical handling of the general average, which means that they will be responsible for calculating each party's general average contribution. But before we can even get to calculating the GA contribution, they must first, the first concern really for all shippers with cargo on board the ship will be to retrieve the cargo that was left undamaged. And before the cargo owner can do that, they must first place what is called an average bond. So what is an average bond? An average bond is a cash bond that must be placed, and it acts as a promise to pay the general average contributions once they have been calculated. Now, in most cases, the carrier will require an average bond be placed before even agreeing to unload the ship. The carrier has the right to take part of the cargo as payment of the cargo owner's contribution if the average bond is not received. It is important to remember that in the case of a general average event, all parties will be held responsible to cover the proportionate amount of the costs incurred to save the ship. Therefore, if a cargo owner does not promise to pay their contribution by placing an average bond, the carrier may decide to use the cargo itself as collateral. An average bond stays on file until the general average contribution has been calculated. Now, this calculation can take years to complete. In a typical example, the calculation can take as long as 5 years. Now, as stated previously, this average bond is a cash bond the cargo owner must place and keep in place until the general average contribution has been calculated and paid. This means that that cash amount that is placed can be held for 5 years in some cases. So it's important to keep that in mind, that this is separate from your general average contribution. This is separate from any claim that arose from this event. This is literally just a bond that's promising to pay your contribution when it has been calculated, and it stays on file until that's been fulfilled pretty much. Now, the monetary amount required for the average bond can range wildly. but it is often determined based on a percentage of the CIF value of the importer's goods. In one past example, an importer's cargo on board was valued at $50,000, and the average bond was quantified as 10% of the valued goods. Therefore, the importer had to place a $5,000 cash bond before they were able to claim their goods off the ship. Now, if a cargo owner has cargo insurance, that includes, the cargo insurance that includes coverage for general average, because we'll get into this a little bit more, but not all cargo insurance includes coverage for general average. But if your cargo insurance does, then the insurance provider will provide a financial guarantee that the contribution will be paid. Therefore, an average bond will not be required, and the cargo owner can immediately claim their goods. So going back to our 4 cargo owners, if cargo owner 1 and 3 did not have cargo insurance to provide a financial guarantee, they would have to place an average bond before claiming their cargo. Cargo owners 2 and 4 would not, since their cargo insurance provides that financial guarantee. Now, everything we have gone through so far is one small piece of the process. So let's jump to the rest of that general example and see how that general average contribution is calculated. Because remember, this average bond is a promise to pay that general average contribution, and it must be placed before you get your cargo that was on that ship. So let's get into how that contribution is calculated. The first thing the average adjuster is going to calculate is the general average claim amount. This figure will include all the expenses that went into the effort to save the ship from peril. There is an important distinction to make here. The general average claim amount is only the expenses incurred in order to save the ship. Therefore, if a fire breaks out on board the ship and many containers catch fire, the container's loss due to the natural spread of the fire will not be included in this calculation. That loss would be handled separately between the owner of that container and their cargo insurance. However, if your container has to be broken into or sawed through in order for the firefighters to get to the fire in the effort of containing it, that would be included as an expense in the effort to save the ship. Other examples of costs would be the cost of safe harbor, the expense of those firefighters, etc. So you can already kind of see how complicated this first calculation is. The average adjuster must first determine what is considered an expense towards saving the ship and what is considered a more typical, marine loss. For the purposes of keeping the math simple, let's say that those expenses in this general average example equate to $5 million. This is the total amount that must be paid by all parties involved in the sea venture. In order to calculate how much each party must contribute toward this total, the adjuster will look at the total value of the voyage and what percentage of what belongs to each party. Those percentages will then be applied to the general average claim value. So keep this $5 million in mind, and let's jump back into how the rest of it's calculated. Now let's calculate the total value of the voyage first. Again, for the sake of simplicity, the breakdown of the cargo's value is as follows. Cargo owner number 1's interest is valued at $5 million. Cargo owner 2's interest is valued at $2 million. Cargo owner 3's interest is valued at $1 million, and cargo owner's 4 interest is valued at $500,000. This equates to a total cargo value of $8,500,000. If the vessel owner's interest is valued at $10 million, then that plus the cargo value would mean that the entire voyage is valued at $18,500,000. Now we have to calculate the percentage of that total each party represents. In order to calculate that, we take each party's value and divide it by the total value of the voyage. This gives us the percentage of each party's interest in that voyage. So for the ship owner, that would be 54%. For the cargo owner 1, it would be 27%. For cargo owner 2, it would be 11%. For cargo owner 3, it would be 5%. And for cargo owner 4, it would be 3%. So that is the percentage that each individual in the voyage represents toward the total value of that voyage. So now we take those percentage and apply them to the general average claim amount that we discussed earlier. So basically we take those percentages and multiply them by the general average claim amount, as you can see, and the resulting figures are the amounts that each party is responsible for to cover the cost of the general average event. This is what it means when stating that each party is responsible for a proportionate contribution. The amount of your contribution is tied to the value of the cargo you had on board that ship. Again, this is an extremely simplified example of how a general average contribution is calculated. There are many factors that go into the calculation that are specific to each general average case and scenario. However, this is a general look at how the math breaks down. We do have a short educational video that covers the same example in a little less detail, so you can always go and watch that for a quick refresher. It is on our YouTube channel. Now, I want to reiterate this point one more time because I feel like I didn't really touch on it enough yet. The general average claim amount is calculated using the expenses incurred in order to save the ship from peril. Therefore, any cargo lost by other means would not be included in this calculation. Therefore, if you lost cargo during a general average event, but not in the effort to save the ship, that would be filed as a separate claim on your cargo insurance policy. So another example of this is if your cargo was jettisoned from the ship during a heavy weather event. Now, if your cargo is damaged or blown off the ship as a result of the storm itself, that would not be included in the general average contribution. Instead, that would have to be claimed as a loss on your cargo insurance policy. However, if the ship is taking on water due to the storm, and the ship captain and crew are forced to jettison containers in order to keep the ship afloat, the value of those containers would be included in the general average contribution, since they were lost in an effort to save the ship. So many of you now might be wondering, how often does a general average event occur? Is this something I need to worry about? I mean, the short answer to that is yes, but we'll kind of illustrate how much. So although general average events are not as common as a more typical cargo insurance loss, they do arise and they pose a very high level of risk, since the monetary responsibility can be higher than your average claim. General average events are also a higher risk, since you are responsible regardless of if your cargo was immediately affected. So to better illustrate the frequency and unpredictability of these events, let's look at a couple of recent occurrences. The most recent example is actually very recent, as it just happened this past Tuesday. On December 10th, on December 8th, today is December 10th, on December 8th, a vessel headed to Long Beach was forced to head back to Japan after encountering heavy weather in the Pacific. The weather caused a massive container collapse that resulted in approximately 1,900 containers or more, still being calculated, to fall overboard. Since this happened so recently, the final tallies of those lost containers is still pending, as well as a lot more information is still coming out. The event has not officially been declared a general average event quite yet, at least as of yesterday. Sometimes this declaration can be made a week or so after the initial event, once things are kind of figured out a little bit more. But as more and more details come out, this declaration does seem highly probable. In this case, it could be considered a general average event since the vessel's master was forced to return to a safe harbor in order to prevent further loss of cargo and ensure the safety of the voyage itself. Another interesting thing about this is with 1,900 containers lost in the storm itself, it would be the record of number of containers lost on one ship since I think the fire on, I can't remember the name of the ship right now, but it would basically be a new record. So not exactly a fun record, but just an interesting fact. Another recent event occurred back in January of this year. A fire broke out in a container stowed on the deck of the Yantian Express while in transit in the North Atlantic. The fire started on January 3rd, and the effort to put out the last burning containers continued until January 26th. This one was declared general average as it took many resources to put out the fire and save the ship from peril. The cause of the fire is believed to be a misdeclared container of coconut charcoal, which is capable of self-igniting. Now, typically, any flammable goods with the potential for self-ignition require testing and certifications for shipping. So it is suspected that the shipper may have misdeclared the cargo in order to avoid these compliance requirements. However, that has not been confirmed at this time as the investigation is still underway. So, I am not the authority on that. This, however, is a good example of why shippers need to protect themselves from the unpredictable. You can control what is in your container, your safety precautions and security, but you cannot control the container next to you. TRG actually has about 7 clients that were affected by this specific general average event, all of which will be awaiting the calculation of their general average contribution, which obviously is going to take some time. So what can you do to protect yourself? Well, the best way is to have cargo insurance. Besides providing coverage for a typical loss, cargo insurance provides coverage in a general average event. However, not all cargo insurance provides general average coverage, so please be sure to check directly with your insurance provider to be sure. All TRG policies include coverage for general average, so if you have a policy with us, there's your answer. In the event that general average is declared, cargo insurance acts as a financial guarantee, eliminating the need for the cargo owner to place an average bond. Also, once the general average contribution is calculated, the amount can be filed as a claim on your cargo insurance policy. So keep in mind that if there was a general average event and you did lose some cargo as a result of the event itself, not only are you going to want to file a claim for that lost cargo, you're also going to have to pay your general average contribution. These two things are separate. So you can kind of see how these become very, very costly and pose a higher risk for you. And again, these are unpredictable situations. So it's not something that, your cargo insurance is really going to necessarily hold against you because you couldn't predict that a fire was going to break out on the boat or that you were going to encounter a heavy storm that caused the crew to act in a certain way. But it's important to keep in mind that these two monetary amounts are separate, and cargo insurance would obviously help cover both. Okay, so now we're going to open up the discussion for some questions. I saw a couple come in during the presentation. Again, I'm only going to answer the ones that I feel are appropriate for me to answer. If your question is more specific, please still submit it, and I will pass it along to one of our cargo insurance experts to answer directly after the webinar. Before I get into those questions though, just while some more people are submitting them, I want to take a moment and talk about TRG. Now at TRG, we sell directly to consumers. So rather than purchasing through a third party, we're going to help you out by letting you buy direct. That gives you an option for lower pricing and very competitive customer service and claims assistance. In addition to providing U.S. Customs bonds, we also write all risk annual cargo insurance policies. We are also proud to announce that we are able to offer more flexible pricing options than ever in an effort to help importers protect their cargo while protecting their immediate cash flow. All of our policies are written through the Lloyd's of London or XL Catlin markets. Now, Lloyd's of London is the largest insurance market in the world. They basically created cargo insurance. XL Catlin is a domestic provider that enables us to underwrite policies at a low price. Now, we offer local representation. If you have a loss, you are going to be speaking directly with Felicia and her team. But that doesn't mean that we can't handle a loss anywhere. We have representatives around the world ready to help in the case of a loss to make sure that you get paid the right amount quickly. Finally, our policies are custom. We offer all three: international, domestic, and warehouse coverage, and they are wrapped around your business. They are not blanket statements. These are not off-the-shelf policies. These are policies written directly for you based on your business, making sure that you have the coverage you need. All our annual all risk policies start at some of the lowest annual costs in the market. Okay, now let me take a look at some of these questions. Just give me a second here. This one's an interesting one. I'm not sure if I really know the direct. So the question is, in the event of a fire on board a vessel, would water damage from firefighting efforts be classified as a general average loss? Now, my gut would say yes, being that it is damage that was incurred in the effort to save the ship. I honestly, I feel like this would be a case-by-case basis. I think that the average adjuster would probably make a ruling based on, how the damage was incurred, what happened exactly, what the firefighters had to do, things like that. But my gut would say that yes, that would be included in the general average contribution since it was in the effort to save the ship. Let's see. Can general average be contested if it can be proved that the ship's officers were negligent or at fault? Not really. In this case, this is the purpose of general average is to basically alleviate the ship and crew. Well, alleviate's probably the wrong word, but it's basically to make it so that the ship's crew and captain can take the necessary action to save the ship. Now, general average is typically things like those examples that I kind of went through before: a fire on board the ship. There's another example that we actually have a full blog post on about a ship that ran aground pretty much right off port as well, and it was stuck in the mud for I think about a month. Obviously delaying containers, and it took a very long rescue process to they had to offload containers off of that ship in order to lighten the load and refloat the ship. And, it would be very difficult to take those actions if the feeling was that then, people could come and contest the general average, the calling of general average, because they felt like, oh, well, the captain they should have known that low tide happened. I mean, really, the ship ran aground because of a lot of different factors that nobody could really control. And then they had to take action to save the ship and save the cargo. And in order to take those actions, they kind of need to know that these things are take precedent. If you think about the legalese of being able to undo a general average declaration, it would kind of mean that the ship and the crew would pause when taking action, would have to seek approval from a higher up before taking action. And in a emergency event like a fire on board the ship or encountering a heavy weather storm, things like this, the crew and the captain really have to make those decisions pretty quickly. So I've never seen, again, I'm not the utmost expert on general average, but I've never seen a general average declaration that has then been overturned. Let's see. Okay, so this one's interesting. The question is, What does overloading do to the general average calculation if the liner took on more cargo than the rated capacity for the ship? This one, I'm not really sure of the details on. I do know that, when loading ships, they really shouldn't be overloading the ship. I know that sounds like an oversimplification, but there's a lot of protocols in place to make sure that that doesn't happen. If they overloaded the ship, again, general average is really only called if an emergency happens. So if they overloaded the ship and then something happened as a result of that, that isn't an emergency, maybe it wouldn't be general average. This is kind of why there's sometimes a delay between the event itself and the declaration of general average, because it sometimes takes time to figure out, is this general average? In this case, I would assume that if it was found within that period that the situation happened as a result of overloading the ship, that the event would not be declared general average at all. But I honestly, this one I'm not entirely sure of. I'll probably submit this one to our cargo insurance experts and see if they have some more information for you. All right, and then we have one more here. Let me see. Okay, so this one is the general average component of a marine cargo line of insurance cost prohibitive from a premium standpoint? So I can only really speak to TRG's cargo insurance policies, and we do not charge extra for general average. General average is just a part of the coverage. Again, because general average it's very unpredictable. I mean, any loss on the high seas is very unpredictable, I know, but in the case of general average, it's even more unpredictable. You really, these things, they do happen. I don't want to tell anybody like, oh, it'll never happen to you, because you never know. I mean, there are people that have been shipping for 50 years and have never been involved in a general average event, while others, there was once a stat that said an importer will be involved in a general average event every 8 years. I don't really know how accurate that is. But basically, because these are things that you really can't prevent against, like for instance, if you have a cargo insurance policy and you have security cameras and tracking and all of these things set up to protect your cargo while it's in transit, that can affect your premium. Whereas in a general average event, you really can't do anything to protect against that. It is truly a unpredictable situation that now you're in. And it is something that is it affects everybody, whether your cargo was affected or not. So it really wouldn't, at least to me, it really wouldn't make sense for your insurance provider to charge more for that. But I know the insurance market is hardening, so I could see things like that happening from certain providers, but at least from TRG's standpoint, that is just a part of our coverage. And I would just check with your provider, or if you're getting quotes, make that part of the conversation. We did get a couple more. Let me see. Let's go. So this one is a little tricky, and I am not the expert to fully answer it, but I can at least give you a little information. So the question is, would all risk insurance cover penalty clauses for late performance of a project due to cargo loss? In general, cargo insurance does not cover delay in that way. Again, this is going to be a better question for our cargo insurance experts, so I will submit it to them. But just in general, cargo insurance does not cover delay. So if you are involved in a general average event, that would not be part of it. So just kind of keep that in mind, that is another potential risk. So some of these are getting a little bit more specific. One question was asking if I have an example of a cargo insurance clause that does not cover general average. I really don't off the top of my head. My first instinct would be that a cargo clause C might not include coverage for general average just because that is the most restrictive cover, but that I will follow up with our cargo insurance experts to make sure on that one. So don't hold that as absolutely absolutely true. Because yeah, it probably does include some coverage. So I'm going to submit that to our experts. I don't want to tell you something that's not true. Okay, so these other ones that have come in, I feel are better for me to submit to our insurance experts. So I'm going to go ahead and kind of finish the Q&A for this presentation, but thank you for submitting all of those questions. I will be sure to submit those right after this webinar to our marine insurance experts so that you can get answers as soon as possible. But yeah, so thank you so much for attending today's webinar. I really hope that you got some information, you got some questions answered. We really try to put these things together to get the most information to the most people. And we know that this is a confusing and kind of unprecedented time, and the TRG team really wants to provide support where we can. Now, if you have any other questions, please don't hesitate to reach out to me directly by email at marketing@traderiskguaranty.com. Additionally, check out our blog. It's at traderiskguaranty.com/trgpeak. It's got a treasure trove of excellent articles and information. Also, don't forget you can find us on Facebook, Twitter, LinkedIn, and of course, YouTube. We will be sending a follow-up email either tomorrow or Monday with links from the presentation and with the presentation itself. So look out for that in your inbox. Again, thank you so much for attending today's webinar. I hope you have a great weekend.